you do a simple math there, and you look at total market cap of equities as a percentage of GDP to bring them back to 100%, which is still very rich historically. So the total value of equities divided by the GDP, that the ratio is now 180%. It should be more like 100%. It's a 40% correction in both those series to bring us back to not a bargain basement price for homes and not a fair value, or not a cheap valuation for the stock market, just something that's, reasonably affordable or reasonable historically speaking. A 40% crash.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a wonderful discussion lined up today that I'm very eager for. Today, we're fortunate to have with us Michael Pento. Michael is the founder and chairman of Pento Portfolio Strategies, a registered investment advisory firm. He has more than 30 years of professional investment experience, having worked on the floor of the New York Stock Exchange during the mid-90s. Michael served as an economist for both Delta Global and EuroPacific Capital, and was also the portfolio creator and consultant to Delta Claymore's commodity portfolios. Michael, thank you so much for joining us today.
My pleasure, Gary.
So, Michael, let's begin with how you're seeing the world today. What has your attention, the market, the economy, geopolitics, wherever you want to take that?
Well, first of all, I thought I was disgusted last week, last interview I did with Jerome Powell. In his press conference, he was actually asked a question. His press conference was yesterday, Wednesday's meeting and press conference. He said, are we in a position of stagflation right now? And he goes, well, I don't see the stag and there isn't any inflation. And he kind of like chuckled about it. And I'm thinking to myself, well, now, you hesitate, Gary. You don't want to call these people liars because you sound like you sound disrespectful. You sound like you're out there a little bit and, not very mainstream. And I'm not a mainstream guy and I'm kind of proud of that, but there's no stag. Let's just say why he said that. So GDP growth fell from Q4 to Q1 of 2024. So Q4 of 23 to 24, it was cut in half. There's 1.6% seasonally adjusted annualized rate. You cut GDP growth in half down to a one handle. That's a pretty good indication that you're headed towards an anemic economy. Mm-hmm. The manufacturing part of the economy had been in a recession for well over a year, and it slipped back into it. We had the ISM manufacturing survey released on Tuesday, so you had the data already, and it showed that we slipped back under 50, which is in a contractionary mode. So we have a recession in manufacturing again. And then when you look at the inflation part of that, it drives me crazy. I heard over and over again today, the mainstream financial media was like, oh, well, inflation's 3.5%. That's nowhere near where it was in 1981. Well, the total debt to GDP was, 40% back in 1981, national debt to GDP. And the total market cap of equities was like, 50% to GDP. And now it's 180% to GDP. We have asset bubbles where home prices have gone up, 45% in the last 2 or 3 years. Food prices up 37% in the last couple of years. So the last read of inflation had a headline figure was 3.5%. That's not 2. So inflation is rising faster. The previous reading was 3.2. So from 3.2 to 3.5 on the second derivative, the rate of change. So not only is the first change accelerating, but the rate of change is accelerating. It's nowhere near 2%, and it's accelerating from a level where most of the middle class can't afford to even eat. Okay? You have 78% of Americans who are living paycheck to paycheck. So talk about how out of touch these people really are from reality.
Yeah, they're out of touch, but what can be done? They're in control. They're the money masters, and they're making the decisions, pulling the strings. They're going to keep it higher for longer. Inflation is going to stay elevated. What can be done?
Well, what can be done is, well, first of all, what can be done is that they could have not have increased the base money supply. So let's think about money, the theory of money and credit. I don't know how much in the weeds you want to get. What are we talking about here? So it's not just currency and coins in your possession. It's high-powered money, which is the base money supply. So it's physical coins and currency, and Fed credit, which is the building blocks of all bank money, which is how you generate. We have a debt-based monetary system. It's how you generate money in this economy, in all fiat economies. Well, that base money supply went from $700 billion in 2008, at the end of 2008, all the way to $9 trillion. And what did that $9 trillion, that $8.3 trillion increase in the base money supply, why did the Fed do that? Well, do that to buy bonds and take the 10-year Treasury note down to 0.33%. It did it to buy mortgage-backed securities, to take mortgages down to 2.7% post-COVID, and that didn't have any effect on inflation. That didn't just see. This is why there's such a yawning, trenchant gap between the very wealthy and the poorest of Americans. There's no middle class anymore. People can't. There's one. Half the population or three-quarters of the population has living paycheck to paycheck. Half has no savings at all, negative net worth. And then there's people on the other side of the expression of the pendulum that have multiple houses, and their asset prices are going crazy, right. And so the Fed is responsible. What could the first thing they could do? You ask me, stop printing all this money and drain the liquidity from the banking system, so we don't have asset prices, stock and bond prices and real estate prices go through the moon, and then you'll have some kind of parity or equilibrium in the economy.
Yeah, and that's absolutely true. Austerity is really the measure that needs to be taken, but it's not a measure that has or will be taken. It's clear, right? But Michael, you recently made the following statement on Twitter or X that I would like you to speak on and expand. You wrote, home prices, which you were just touching on, and stocks need a 40% drop to match historical averages. This could trigger a full-on depression and bankrupt the financial system. But will the Fed be forced to try and keep these asset prices from falling? Would you speak deeper into that statement?
Okay, so so if you look at the NAR data and the census data, you get median home price and you have median incomes. So if you look at both those data series, you'll see that home price to income ratios are now at 5.5. That's the home price to income ratio. Now, I didn't touch on the cost of maintaining the home. I didn't speak about the insurance costs for the home.
The increase in property taxes.
I didn't talk about the property taxes of the home. I just talked about the home price to income ratio. It's 5.5. It was 2.8 in the year 2000.
Wow. To
give you some semblance of reality. So you do a simple math there, and you look at total market cap of equities as a percentage of GDP to bring them back to 100%, which is still very rich historically. So the total value of equities divided by the GDP, that the ratio is now 180%. It should be more like 100%. It's a 40% correction in both those series to bring us back to not a bargain basement price for homes, and not a fair value, or not a cheap valuation for the stock market, just something that's, reasonably affordable or reasonable historically speaking. A 40% crash. Now, let me ask you a question. And this is just to wrap up the thought. What would that do to banks' assets if home prices fell by 40%?
Yeah.
What would the economy look like if the top quintile, which is keeping the economy afloat, lost 40% of their equity value?
Yeah, I think many of us are asking these questions, and yet the Fed keeps liquidity high in order to keep these asset prices elevated, don't you think?
Well, that's why.
Yeah.
That's why. So they have no. So that's why Powell's like stagflation. There's no stag. There's no inflation. No, he knows there's stagflation. He doesn't care.
Right.
He doesn't care because he was put in place by Congress in 1913. Not he, but the Fed. The institution was put in place to be a lender of last resort to banks. It was not, the charter wasn't, how do I protect the middle class of the United States of America? How do I keep the purchasing power of the dollar stable? No, none of those things are in the charter of the 1930 charter that gave the Federal Reserve its power.
Yeah. So to your point about the asset prices, here's something interesting. Currently, asset manager positioning in U.S. equity futures is hovering over 2 standard deviations above average. So do you anticipate a reversion to the mean here? And truly, what's the impact on the markets if there is a reversion to the mean?
Well, a reversion to the mean, reversion to mean in the markets would mean a 40% crash. We just talked about that. That would be absolutely devastating. Wipe out pension. There wouldn't be a solvent pension plan on the planet. I mean, it wouldn't be an insolvent insurance company. The banking system would be wiped out. So it's not going to be allowed to happen gracefully. I can tell you that. Powell's already now. He launched the BTFP, the Bank Term Funding Program, in March of 2023, and that kind of kept the regional banking system afloat. But all of the assets of the banking system that were problematic then are even worse now because mortgage rates are higher and bond yields are higher. So, and what are these banks are loaded up with? Treasuries and mortgage-backed securities. So, and the transaction market for housing real estate market is frozen. Yeah. So it would be devastating. So the Fed has no choice. They either have to continue this ruse to keep trying to inflate, keep printing money, keep growing the balance. They already cut the balance sheet. And you ask yourself, oh, Michael, if inflation is 3.5% and their target is 2 and it's moving further away from 2, why are you cutting the pace in the reduction of the balance sheet? Why are you looking to make financial conditions easier when they're already easy and getting easier? Why are you trying to make credit spreads tighter when they're already tight as can be and getting tighter? It's tight, the tightest spreads to treasuries in history, virtually right now. And he wants to loosen financial conditions because he's doing everything he can. He knows that he's on the precipice of, if reality hits, if market forces were allowed to play out, home prices would drop 40% at a minimum, and they never just drop back to level. They always go through that. So they drop probably minimum 40. Asset prices equities would drop at least 40, maybe more. And the economy would not be in a recession. It wouldn't be in a depression. It would be in a severe depression. So to avoid all that, because we're so unhinged from reality, he's already pivoting now to reliquify the banking system that doesn't need to be reliquified.
That's amazing.
He can't risk it. He can't risk another repo. That's why he's like, oh, remember in 2019 we had the repo crisis? We can't risk that. And even though he has a standing repo facility, in other words, the Federal Reserve now is in place to falsify asset prices as much as possible. That's their new charter.
Yeah.
And be screwed and damn the middle class and the purchasing power of the dollar.
So, Michael, you recently shared that the U.S. has abused our reserve currency just long enough, and we're living in the environment when it's ending. Would you break down that statement for us?
You said what? I'm sorry, I missed the first part of the question.
Yeah, you had shared that the U.S. has abused our reserve currency just long enough, and that we're living in the environment when it's ending.
Yeah. Post the Bretton Woods Agreement in 1944, the U.S. dollar was backed by gold, and we were the only manufacturing base in the world. Europe was in tatters, Japan was in tatters, China was not, still an agrarian society. So what we did was we, had the world's reserve currency, and every country that produced its excess goods would park their reserves, their currency reserves, their trade surplus in U.S. dollars and in U.S. treasuries. And that worked for a very long time. And now we see that the United States is now an insolvent nation. And you add on top of that fact that we're now enamored with telling countries that you used to have X amount of dollars in reserves. Well, they're not yours anymore. We put sanctions on, and we, using our hegemony, say, we just cut off.
We confiscated Russia's
confiscating your savings. So I think China and maybe Venezuela and Brazil and Russia, just to name a few countries, and maybe other countries too, are saying, why do I want to subject myself to having the United States have the power to usurp my savings, my currency reserves? So what I'll do is when I have a trade surplus, what I'll do, instead of recycling it into treasuries and dollars, I'll just park it into gold or Bitcoin. And the latter I don't agree with, but the former I do. So I would, if I were in charge of foreign central banks, I would park my trade surplus and currency reserves in gold rather than the United States. Now, gold doesn't have any yield, so I understand that, but at least gold is in your possession.
Mm-hmm.
The United States cannot unilaterally decide that your gold is not yours. So you can store the gold yourself. So that there's a big upside there. And if the United States is going to be in a perpetual condition of interest rate repression, where they're pushing down yields far into negative territory, then you have to make the calculation of really what yield am I really foregoing here by owning gold? I'm better off just owning gold, because in real terms, the rate if you take out currency depreciation, I'm going to be left with nothing. So that's the calculation now. The U.S. hegemony, the U.S. dollars abused that privilege of having the world's reserve currency for decades, and it's ending. It's not my opinion; it's just a fact.
Yeah. And short of an invasion to take the gold, there's no way to get access to it. So gold broke through that critically important 2070 resistance area that held for almost 4 years. In this cycle, it's currently peaked at a little bit over 2,400. Gold is typically a barometer for the health of the currency. What's gold telling you right now, and what do you see coming next for gold?
Yeah, it's funny. I was just doing some work yesterday, and I'm thinking, the Japanese. Let's just go to the Japanese economy. The island nation has virtually no natural resource. Has to import everything. The Japanese yen versus the U.S. dollars dropped by 15% year over year. 15%. That's a big move in a currency. Their biggest trading partners, China, Europe, and the United States. So the Bank of Japan actually has the audacity and the mendacity to claim that inflation is only 2.7% in Japan. And then I looked up. I said, well, gold is the big reveal. Gold is truth. Gold is true and honest and real money. So what has the yen done against an ounce of gold? And then I found out it was down 39% last year. 39%. So that's more indicative of what's really happening on the ground in Japan. So what gold is telling me, and it's telling you and it's telling everybody else, that fiat currencies are being just printed with reckless abandon now, because they have this tool, the tool they have, unfettered. They can print as much as they want. And we, in the United States, even though we promised we would never do anything like that, the central bank promised us in the 90s, I remember, saying, some of the Mr. Fisher was saying, and he was a great man, I'm not disparaging him. He just said, we will never print trillions of dollars and monetize government debt. That's exactly what you did. It's exactly what the United States has done. And of course, gold is the great revealer. That's the major move behind. That's the major impetus behind gold. In other words, gold is sniffing out, yes, international geopolitical strife. Of course, that's the case. But what gold is really telling investors is that real interest rates can never be positive for very long without destroying the economy. Hence, you're going to have a perpetual and protracted condition of negative real interest rates, which is why you own gold. You preserve your purchasing power. It's a placeholder of your wealth. Clearly, Japanese citizens know that.
Yeah.
And the American citizens know it too now.
I don't want to put words in your mouth, but clearly it sounds to me like you believe that this is going to be a protracted, as the word that you just used, an elongated period where, being in gold will be a move similar to the 70s, early 2000s, because of the length of time that this is going to take to work through this system, this issue. But Michael, I'm also curious, do you have a investment thesis on silver?
I do. I'm not going to like it probably because I've been in the business 33 years. So my experiences tell me, as you know, inculcated to me over and over again that silver, poor man's gold, it has a lot of industrial components to it as well as precious metal components. So it's a hybrid, and that's what keeps it down. If you put up a chart of gold versus silver, it's just no comparison. So gold has less volatility. It's got much more stability. As a matter of fact, that it says less volatility is more stability, and it performs a lot better. So when you think about a period of intractable inflation globally, with an accent on the stagflation part of that, intractable inflation with a big component of stagflation, that's when gold will far outperform silver. So silver does better in very, very truncated periods of times in history. That's when you have growth and inflation at the same time. I don't see that. I see the next macroeconomic condition to be one of disinflation and recession in the United States. And if you listen to a lot of these earnings reports that are coming out for the first quarter, they're all saying the same thing. The consumer is weakening. The discretionary power, purchasing power of the consumer is attenuating quickly.
So before and I'm seeing a lot of the same things there, and I appreciate your viewpoints, by the way. So before we move on from the precious metals, I just wanted to ask you about the miners. Michael, what's your investment thesis on the gold and silver miners? Do you see them as undervalued versus the metal, priced fairly because of their costs? Are you allocating any dollars there?
Okay. So in complete disclosure, I have about a 10% position in physical gold. That's outside of what, okay, so I always tell my investors, start with a 5% position in physical gold that you own, and no bank and no entity, no brokerage firm stands between, no third party stands between you and your gold. Start there. Then I have an allocation of 10%, which I call liquid paper gold. So it's an ETF that supposedly has physical gold, but it's a way of you can invest your money like
like the GLD,
IAU, AAU, yeah. So that's what you do when you invest in stocks. I mean, you don't own anything. It's all paper. So in theory, you own something. Hopefully, you own something. So it's the same thing. I call it liquid paper gold, 10%, and I have a 3% position in the miners right now. Miners have they are undervalued to the metal historically, way undervalued historically to the metal. But gold miners, very high volatility profile, and they have very high costs. That's one of the reasons why gold is so precious. It's very extremely rare metal, and it costs more and more money to get it out of the ground. Oil prices are high, so there's some problems there with going overexposed into the miners. Remember, miners are also stocks. Mm-hmm. So in a falling stock market, in one that's in a vicious bear market, miners will get crushed too. So I own them now, but I'm watching them carefully.
Okay, yeah, I appreciate that. So before we finish up, I've got two questions about portfolio positioning. The first being about 60-40 portfolios. The 60-40 portfolio has failed investors since 2021 with the duration bonds getting crushed. The environment since 2020 has changed. Financial advisors and subsequently the investors that they're advising, they don't seem to have really caught up. How should the new portfolio structure look to accommodate for the new environment that we're in?
But this is one of two questions, and this question I could do a whole interview on. So I'll try to consolidate this answer as fast as I possibly can. Because I know we have to wrap up soon. So the 60-40 portfolio works terribly now. It used to work well in the past, but when both asset classes are in a massive bubble, like I said, when the 10-year note was yielding 0.33% not too long ago, that's a massive bubble. I wrote a book about it in 2013 called The Coming Bond Market Collapse. So you have stocks in a massive bubble, bonds in a massive bubble, high yield debts and corporate debts in a massive bubble. where's your protection? Where's your ballast from bonds? You just don't get any. And since the U.S. government is starting from an insolvent condition, this is very unique. So you have inflation and insolvency heading into a recession. Normally, recessions are great for bonds. So that's your offset. Normally, you say, "Oh, I got crushed in my 60% in my stock. Those got crushed, but at least my 40% in long duration bonds really, assuaged or mollified my losses significantly." But this time around, the long duration bonds, because of the massive deficits in debt that we're going to have, you could have a $6 trillion deficit coming out of the next recession if it's similar to the last two. I mean, that's a lot of supply that has to be taken on. And depending on where the funding goes to the Treasury, I mean, if it's funded on duration, you're going to get a tsunami of supply. And then you're going to have the inflation problem. You're starting from not deflation, you're starting from a problem where, hey, you've inculcated to the investors that you have a big problem with inflation that you haven't resolved. So maybe you'll have a period of time where you get disinflation or deflation. But people know investors understand that when you reliquify the banking system, you print trillions of dollars, you hand out helicopter money, you're going to get inflation without end, because no one's going to believe that you have the capability of making that containable.
Yeah. So are you structuring it more? Your portfolio is more like Zoltan Pozar, like a 2020 allocation across commodities, cash, gold, stocks.
No, because I have about I think about 30% in equities, about 60% in shorter term. So I'm on the 1 to 3 year Treasury duration curve. So what I'm doing is I'm saying, I do want to own Treasuries, because I think the Fed's going to be cutting rates, because the Fed controls short-term rates that don't control long-term rates. So when the Fed starts cutting rates, I'm going to have that very high yield, around 5% in the 1 to 3 year duration Treasuries. But I'm also going to get some principal appreciation as the Fed cuts rates. I wouldn't get that in T-bills. And if I go out to zero coupon bonds or to TLT, which is the 20-year plus, I could get killed. I mean, I might make money in the short term, but I have to be, lightning quick to get out of it, because once the Fed is able to reliquify the banking system, inflation is going to take off like mad, and you can get destroyed owning long duration bonds. So the supply and inflation is keeping me away from that.
Yeah. So aside from long-term bonds, is there anything else that you absolutely don't like?
Oh, actually, absolutely don't like. I absolutely abhor with a passion high yield debt. I think you can make a lot of money shorting that if you do it appropriately. You can't hang on to it. You have to know what you're doing. You have to talk to your advisor. I'm not giving you advice, but if you're with me, we will be shorting high yield, junk bonds, because I think they are so overpriced. The soft landing in a perfect economy is already priced in. I can't see any upside in those bonds.
Yeah. Okay. Well, before we wrap up here and I ask Michael our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This is a free gift. It's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address, subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Michael as much as I have. Please let him know. Hit the like button, the subscribe button, and leave a comment below. Michael, in wrapping up our discussion, my final question for you is about your investment models. How does your investment model set your clients up for success regardless of the economic and market environment that we find ourselves in?
So I have something called the inflation deflation economic cycle model. I've been developing it for decades, and I launched it officially in 2016. I look at the 5 sectors of the economy that span between deflation and intractable inflation or stagflation. And if you understand what sector of the economy you're in, so you have stasis, and then on the left side you have disinflation and deflation, and the other 2 buckets are inflation and intractable inflation. And in this 20-point model informs me as to what sector the economy is in. And that informs me what sectors and style factors and asset classes you need to own given each sector of the economy. And that's the best way I found in investing, because it allows you to invest in bubbles, be they of inflationary variety or even the stagflationary variety, in the correct asset classes, style factors, and sectors. But it also informs you when you need to get out of the market. When you say, when you have a recession or a depression, which is, again, that's sector one, that is when, the R squared, or the correlations of all of the assets go to 1. Everything goes down. That's when you only want to own cash, you only want to own short-term treasuries, and you only want to own the US dollar, and you only want to short the market. So that's an extreme example. And there, of course, you can be in between sectors, and there's intensity within the sectors. But that's the most intelligent way I've found of how to invest. Not just being a salesperson and say, let's use a 60-40 and target date portfolio. That works well. That worked well, maybe in the 60s, or before we had a fiat currency. But now we have an environment where there's complete artificial construction of asset prices. They're totally reliant on a fiat currency and a banking system that can constantly create the number of dollars in excess. And they're not always going to be able to do that. And there are times when you're going to want to protect your portfolio from these 30, 40, 50% crashes that are becoming very frequent. I mean, 2000, 2008, 2019, 2020, 2022, we lost 33%. So these are the kind of things you need to avoid. And I just want to close with this one thought. If you look at Japan, I mean, Japan is still underwater since 1989. So that's, was that 35 years? 35 years is a long time to break even in nominal terms, right, Gary? The Shanghai Composite Index, the Chinese exchange, is down 45% since 2007. So, it's not out of the question that we can have a very long period of time here in the United States where stock prices go down in nominal terms, not just in real terms, but in nominal terms. And that it's just being able to understand that, predict it, and try to invest around it. It's just become absolutely mandatory for successful retirement. And that's what I'm all about.
Well, this has been a wonderful conversation. I really appreciate you coming on. Thank you so much for spending this time. Everybody needs to go and follow you. Would you please share with the viewers any final thoughts that you have with those tuning in, where they can learn more about your work and how they can connect with you?
So the website is pentoport.com. We have a midweek reality check, which is published every Wednesday. You can get a 5-week free trial. For that podcast, it's $50 a year. You get my high level, I don't give you specific allocation advice, but I will tell you what I'm thinking about the economy. And if you have $100,000 to invest and you are a U.S. investor, I will manage your money personally in that IDEX strategy where my own money is.
Wonderful. Everybody, I'm going to put all that information up on the video and in the description. Michael, thank you for coming on again. I look forward to having you back on. Thank you for being here with us, and everybody else, thank you for watching.
Gary, thank you for having me on. And next time we're on, we'll have a full show. Maybe we can get a little more involved in these questions. So you did a great job, and thank you for an intelligent interview.
And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This is a free gift. It's a must read for everyone on why we all should own gold. So head over to metallsandminers.substack.com, put in your email address, subscribe, and receive the free gift on us.